Hi, this is Lance Morgan, founder and co-owner of CollegeStickerPrice.com. And in step one, I want to dive deeper into the various financial strategies that are available for paying for college. A lot of people want to know, should they use the money that they've saved up to pay for college? Should they get an extra job and earn some extra income? Should they cash out some maybe 401k or retirement money? Should they use equity in their home? There's a lot of questions about how you actually pay for the cost of a college degree for your student. And as you can see with options 1, 2, 3, and 4 here, they all pay the same amount. Now in the blue column there, that is before tax, and so that's why you have to take out a little bit more to get that same $35,000. But in essence, you're basically paying $140,000 for a child's education. Now this may be higher for some of you and this may be lower for others, but this is just as an example. Now I know there are a lot of numbers on this screen, and I will dive into this in a little bit more detail, and I'll show you a breakdown of how exactly this works. There are 5 main areas that people transfer away a lot of money unknowingly and unnecessarily. And one of those 5 areas is how you make major capital purchases. Now, of course, without question, college funding is one of the biggest capital purchases that you will ever make. And so how you pay for college could be one of the biggest mistakes you can make with your money. Now, all of the numbers are the same in all of these options, but if I fast forward and scroll down to the bottom, we see how these options affect our retirement income. In the green column there with option 1, we are able to actually pull out $3.5 million of retirement income during my retirement years, whereas with the kind of reddish column there, only $1 million, and the blue we pulled out 2.2, but we had to pay taxes on it, so we only actually took home the same as the purple, the 1.6 there. So in both the blue case and the purple case, I only pulled out 1.6 million worth of income during retirement. And if you do the math, that's just shy of $2 million between the green column over there. And so how you pay for college could have a significant impact on your financial future and your retirement. So how does this work, and why is this the case? Well, it all starts with something that you've all probably heard, which is kind of a simple way to explain compound interest, which is taking a penny and having it double every day for 31 days. And as you can see in this example, obviously in the beginning it doesn't really make much of a difference, but as you get closer to day 31, the numbers really start to compound. Now, this is a very simple concept of compound interest, but the reason why I bring this up is because one of the biggest mistakes people make with their money is they don't allow their money to actually compound. Let me give you an example. In this scenario here, we have 2 different scenarios. We have our investment money over here in our investment tank, and we have our safe money in our safe tank. Now, there's a couple of different ways to pay for something. We can either drain these tanks, so let's say that we have maybe a 529 plan that you've been saving for your child's education. Well, you could drain that tank, or maybe you've just got some money in savings that you want to spend, and you can drain that tank. Well, when you drain that tank, you are interrupting the compound interest, and we all know that compound interest works best over time. The problem is that one of the biggest mistakes that we make with our money is we don't allow it to have that time to actually grow. So how can we actually have this money grow and compound over time like a penny that doubles every day for 31 days and still pay for a child's education? Well, believe it or not, we can actually borrow money against our money, kind of using our money as collateral to secure that loan if need be. But that's what allows that money to actually grow. So if our money in the green tank or in the yellow tank is always growing and always compounding, and we use somebody else's money, then we allow that compound interest to really take effect. To illustrate this a different way, there are traditionally a couple of different ways that we're used to thinking about paying for things. There's the debtor, and of course the debtor goes into debt and then they always try to get out of debt. So let's say you take out loans, and then of course you have to pay back, these student loans with interest, of course. Well, of course, a lot of people don't want to go into debt, and so they say, well, I'm going to be a saver, and the saver saves, but then they spend. So they drain that green tank that we were just talking about. They save, and then they spend. So they're not paying interest, but they're giving up the interest that they could have earned. So what can we do that's different, and how can we create that $2 million difference in retirement income like I showed you in the beginning? Well, the way this works is what we call the wealth creator. The wealth creator understands the power of compound interest, and they understand the power of time with their compound interest. And so they take that money that they've saved for college and they allow it to continue to compound. So whether that's money that they've saved into a 529 plan, or money that they've saved into mutual funds or in a savings account, or maybe it's even an extra job that you took on and it's extra cash flow. Well, either way, we want that money to grow and continue to compound. And then what we do is we actually use other people's money. You've probably heard of people talk about OPM, or other people's money. Well, by using other people's money and then either paying that back, or even if it's like an interest-only loan, if we could be earning a better interest rate on our money than what we're being charged on that loan, then we still allow that money to actually grow. Our money in the green there, we allow our money to actually grow and compound. So going back to our visual representation of how this would look, we have this green tank, which is a lot of money earning, let's just say 5%, and then we have borrowed money. Even if that were earning, or even if that were costing us 5%, we're only paying 5% on a small amount of money, and we have 5% being earned on a larger amount of money because we've allowed the power of compound interest to actually work. Now, this works for any major capital purchase. Obviously, college funding is just one of those major capital purchases. Now, our goal, of course, is to show you vehicles and options where you could get, let's just say, a 7% average return in a safe tank where you have no risk of losing your principal, and then borrowing money at 5% as an example. Now you have a 2% spread, and that is how we can see such a big impact in retirement. In other words, there are financial strategies out there that we can go over in detail that could significantly change your financial future and your retirement income. The other part of step one, which is the financial strategies, is lowering your EFC, or your expected family contribution. As you can see at the very bottom of this chart, sometimes you can hide or shelter or move assets around so that they don't count against you for your expected family contribution. And by doing that, of course, you qualify for more aid. In this report, we can see a before and after where we've been able to reduce the expected family contribution. Now, the reason why we want to reduce the expected family contribution is because then we qualify for more need. Let's take a look at this example. We have two different colleges. We have Davidson College and we have University of Kentucky. In both scenarios, my expected family contribution is $12,000, which is based on my financial situation. However, for the University of Kentucky, my cost estimate is $22,000, whereas with Davidson it's $63,000. So obviously a very big difference in sticker price when it comes to the cost of Davidson versus University of Kentucky. It appears that Davidson is a lot more expensive. However, since my expected family contribution is $12,000 for both of them, then the next thing we look at is what percentage of that need is met by the University of Kentucky. And as we can see here, only 72% is met, whereas with Davidson, 100% of that need is met by Davidson. Now, my need is only $10,000 with University of Kentucky, because if you take the $22,000 minus the $12,000, I only need $10,000. And so University of Kentucky is only going to offer me 72% of that in financial aid. And of course, Davidson College in this scenario is going to give, my need is $51,000. And so if they give me 100% of my need, then they're going to be giving me that full $51,000. Now that could come in the form of gift aid or self-help aid. And in step 4, we will talk about financial aid in more detail, and we will break down the difference between gift aid and self-help aid and the percentage of need offered by different schools, which is, of course, one of the steps in making sure that you are getting the best education for the lowest price possible. So that's step 1 out of the 6 steps to getting the best education at the lowest price. And as you can see in step 1, with the financial strategies that you use to pay for college, it can significantly impact not only the cost of college, but it can significantly impact your financial future and your retirement income. Thanks for watching.